How you pay yourself as a business owner depends on your legal business structure. What works for a sole trader won't always work for a limited company director. But don't panic though, this video will tell you all that you need to know. Let's start with sole traders. Now, if you are a sole trader or a partner in a partnership, you don't take a salary from the business. This is because the profits and money in the business are yours. So you can simply take money from the business as and when you need it, and then record this as drawings in your bookkeeping records. You can also use your own personal bank account, but we would recommend setting up a different bank account for all of your business transactions. Then you can transfer money into your own personal account as your drawings. If you are a sole trader, you are not taxed on the amount of money you take, but instead on the profits of the business. And it's a good idea to set aside some of these profits to ensure that you can pay your tax bill at the end of the tax year. Now, moving on to taking money from a limited company, this is a little different. Let's say you are a director and shareholder of a company and you don't have any other sources of income, such as another job. The most tax efficient way to pay yourself would be taking a small salary each month and then the remainder as a dividend. This is because as a director, you are an employee of your own limited company. So technically, you are employing yourself, which might sound a little bit odd. Now, employees and employers both pay national insurance contributions on salary payments, but not on dividends. And because of this, there are tax traps to look out for. If you pay yourself a salary that's above both the primary and secondary national insurance thresholds, you will have to pay NI twice. Not very tax efficient if you ask us. And the reason for this is that the primary threshold is for employees, while the secondary one is for employers. And don't forget, you count as both. If you do have other sources of income, it might be better to just take dividends depending on the amount, but double check with an accountant first. So, how do you pay yourself a salary? Good question. Well, first of all, if you want to pay yourself a salary, you need to register as an employer. You then need to decide how much you want to pay yourself. If you chat with your accountant, they will be able to tell you what salary is the most tax efficient. You'll also need to make RTI returns to HMRC on every payday. This is where employers report payroll information to HMRC. It can be done through your accountant or by using accounting software. Every time these returns are submitted, you need to record the payments as a director's salary in your bookkeeping. Now, most of the money that you take from your company will be as a dividend, and dividends are payments from company profits to the company owners, and they can be taken out any time. It's best practice to take dividends officially and by recording minutes and creating dividend vouchers. Don't be caught out though, as dividends must be taken from profits after tax. You need to make sure that you don't take all of your profits and leave the company without any money to pay its tax bill. And if you take too much, you might leave your company insolvent, which of course you don't want. So, as a general guide, don't take more than 80% of your profits to ensure you leave enough money into the company. And that's it. Thanks for watching. Make sure you subscribe so you don't miss out on any of our videos, and give us a like, and if you have any questions, please leave them below in a comment. And if you don't have an accountant yet, don't worry, we've got you covered. Head over to our website and get a free instant quote, and one of our accountancy advisors will be in touch.